If you currently have more than a specific amount of money resting in your standard checking or savings account at this very moment, I need you to grasp something critical. You are silently losing that money in three separate ways at the exact same time. And the most hazardous of the three is the one your bank will absolutely never alert you about. The instant your balance exceeds a particular threshold, the Internal Revenue Service starts paying close attention to you. Your own money quietly begins deteriorating, and a portion of it ceases to be protected altogether. And the bank holding it has zero motivation to disclose any of this to you, because every single one of those three threats generates revenue for them and extracts it from you. So today, Timothy is going to provide you with three things: the precise amount of money that is excessive to leave inside a standard bank account, the three silent threats of maintaining more than that, and then the five particular places that smart retirees actually relocate the remainder of their money so that it is secure, it is shielded, and it is finally generating something instead of sitting idle. Stay with Timothy to the very end because that final section is the part nobody breaks down for you at no cost, and it is where the genuine wealth is. Let Timothy begin with the first threat, the one that catches people most off guard, which is that once you hold a substantial sum of money in one account, you are being monitored. Under federal law, anytime more than $10,000 in cash flows through your account in a single day, the bank is obligated to file a report about it with a federal agency, and that report enters a government database with your name attached to it. But it does not end at cash. The software your bank operates is tracking your balance and your patterns around the clock, quietly scanning for anything that deviates from your normal behavior. A sudden large deposit, a sudden large withdrawal, money flowing in a direction it has not flowed before. You do not have to commit any wrongdoing to get flagged. You simply have to do something unusual. And the larger the pool of money sitting in that account, the more scrutiny it attracts. The most straightforward way to reduce being monitored so intensely is to stop holding so much in the single place that is performing the monitoring. The second threat is the one that is purely mathematical, and it is draining you every single month regardless of whether anyone is observing or not. It is inflation, and at this moment it is running at slightly above 4% annually. That means the price of everything you purchase is climbing by approximately 4% each year. Now here's the painful reality. The average standard savings account in this country today compensates you with less than half of 1% in interest. Consider that again. Your money is shedding more than 4% of its purchasing power every year to escalating prices, and your bank is giving you virtually nothing to offset it. So if you have $50,000 deposited in a regular savings account, that money is silently losing nearly $2,000 of actual spending capability every single year, and you committed no error to bring it about. You simply left the money where the bank preferred it to be. In the meantime, that identical bank is taking your money and lending it back out to other customers at significantly higher rates and retaining the spread. Your money is performing all the labor, and the bank is collecting all the profit. The third threat is the one nearly nobody verifies until it is already too late, and it concerns protection. Every account at every bank is covered by the Federal Deposit Insurance Corporation, the FDIC, but only up to $250,000 per individual per bank. If you possess more than that sum in a single bank, and that bank collapses, every dollar beyond the threshold is not safeguarded, and you can outright lose it. People assume bank collapses are something from their grandparents' era, but in the year 2023, this nation experienced three of the biggest bank failures in its entire history within the span of several weeks. The people who were beneath the limit were compensated fully. The people who were above the limit had to wait and worry and hope. You never want your lifetime savings to rely on hope, when remaining protected is so straightforward to arrange. So now the question you have been anticipating. How much is genuinely too much to maintain in a standard bank account? The candid answer that prudent planners offer is this. Retain 3 to 6 months of your routine living expenses in your checking and everyday savings, and not substantially more beyond that. For the majority of retirees, that falls somewhere between $15,000 and $25,000. That is your safety net, your emergency reserve, the cash you can access in an instant. Everything beyond that amount does not belong in an account that is monitoring it eroding it, and scarcely protecting it. Everything beyond that amount should be transferred somewhere superior, and here are the 5 places that cautious people actually transfer it. The first place is a high-yield savings account at an online bank. These are legitimate, completely insured savings accounts operated by well-established institutions that simply function online rather than on a street corner. And because they are not funding a lavish branch on Main Street, they pass those savings along to you in interest. Currently, these accounts are yielding around 4%, occasionally a bit higher. That is roughly 10 times what your standard bank is compensating you on the exact same money with the exact same federal insurance safeguarding it. The money remains entirely liquid, which means you can transfer it back to your checking account in a day or two whenever you require it. Setting one up takes approximately 10 minutes from your kitchen table. The second place is a Treasury bill. A Treasury bill is essentially a short-term loan that you extend directly to the United States government, and it is regarded as one of the most secure places on the planet to deposit money. You can purchase them in modest amounts directly from a government website called Treasury Direct. And currently, the short-term ones are yielding in the neighborhood of 3.5 to 4%. Here is the detail most people are unaware of. The interest you receive on a Treasury bill is exempt from state income tax. So if you reside in a state that levies income tax, a Treasury bill can quietly deliver more money into your pocket than even a high-yield savings account offering the identical rate. You can arrange them to mature every few weeks so you perpetually have money becoming accessible. The third place is a Series I savings bond, which is constructed for precisely this period in time because it is engineered to match the pace of inflation. The interest rate on these bonds adjusts in accordance with the cost of living, so by construction your money does not forfeit its purchasing power the way it does resting in a standard account. You acquire them from that same government website, up to $10,000 per individual each year. The single rule to be aware of is that you must leave the money in for a minimum of 1 year. So this is for savings you will not require immediately, not for your emergency cushion. The fourth place is a brokered certificate of deposit. Now, you may already be familiar with standard certificates of deposit at your neighborhood bank, where you commit your money for a defined period in exchange for a guaranteed rate. A brokered one simply means you acquire it through an investment account, which enables you to compare the rates of hundreds of banks across the entire country all at once and select the finest ones. And here's the compelling advantage for anyone with a larger sum to safeguard. Through one single account, you can distribute your money across multiple different banks, 25,000 here, 200,000 there, so that every dollar remains beneath that $250,000 insurance threshold at each bank, all of it completely protected, all of it generating a dependable fixed rate. The fifth place is a money market fund, maintained inside an investment account. This is not the same as the money market account at your bank. A money market fund contains very short-term, very secure government-backed debt, and it presently yields in the neighborhood of 4 to 5%. It is entirely liquid, so you can transfer the money back to your checking account in roughly a day. There is no commitment period, and there are no penalties for withdrawing your money whenever you choose. For a retiree, it is one of the most uncomplicated places to station larger sums of cash while still collecting a genuine return on every dollar. Now, let Timothy connect all of this together, because the common thread running through every piece of it is identical. Maintaining a substantial pile of money in a standard bank account does 3 things to you simultaneously. It places you under a vigilant eye you never consented to. It allows inflation to silently consume your savings while the bank compensates you almost nothing. And above a specific threshold, it leaves your money unshielded entirely. The remedy for all 3 is the very same straightforward action. Retain a few months of expenses in your everyday account and relocate everything above that into your own name, into accounts that are more secure, completely protected, and actually compensating you. You are not assuming risk by doing this. You are eliminating risk from the equation and receiving proper compensation for the first time in years. The Internal Revenue Service is never going to contact you and explain how to attract less of its scrutiny. Your bank is certainly never going to contact you and explain how to generate 10 times more on your money elsewhere, because that money departing is money it forfeits. The sole person who can choose to relocate it is you, and the relocation itself is far more straightforward than the bank wants you to imagine. The majority of these accounts can be established from your own residence in less time than it takes to drive to the branch. Timothy will place the names of these account types and the steps to establish them in the description below. So do one thing for Timothy right now. Forward this video to one person you cherish who is over 60 and still maintains most of their savings deposited in a single checking or savings account at one bank. A parent, a sibling, a friend, someone at church who labored hard their entire life and was simply never informed that their own money could be both more secure and generating more at the same time. That one share could rescue them a fortune in forfeited interest, safeguard every dollar they possess, and quietly remove their name from a list they never realized they were on. That is what US Updates Hub is here for. Timothy will see you in the next one. This video was created solely for educational and informational purposes by US Updates. Hub, hosted by Timothy. Nothing in this video should be interpreted as legal, financial, investment, or professional advice. Individual financial situations differ significantly. Always consult a licensed financial planner, certified public accountant, tax professional, or qualified advisor before making any decisions about your savings, investments, or bank accounts. US Updates. Hub and Timothy bear no responsibility for actions taken based on this content. For official information, visit FDIC.gov, IRS.gov, and TreasuryDirect.gov. Viewer discretion is advised.